Alright, so this video we're going to talk about the multi-product break-even point. So in the other videos when we talked about break-even point, we've really been focusing on a very basic calculation where we've only got one product that we sell, just to lay the foundation and the building blocks. The reality is, however, most companies have more than one product that they sell. So the question is, how does that all work? How do we calculate the break-even point when we have more than one product? Now, we have to make certain assumptions. And what we're going to focus on when we do the calculation, it's still all the same. It feels like the same calculation for break even, but we have a couple of extra steps that we have to build in. And one of the assumptions that's key is that we're going to base our analysis on the current sales mix. And we have to make the assumption that the current sales mix will continue on. Meaning that if 50% of my current sales are product A, 20% are product B, and the other 30% are product C, then I have to assume that moving forward that sales mix will stay the same. And if we make that assumption, then we can do a couple of extra steps and we can come up with what the break-even point for a multi-product company would be. Right? The critical decision here is what mix of products to sell, or should we sell, or do we need to sell to break even? Now, this dovetails into what you will do when you get into incremental analysis and you start talking about which products should I sell to maximize profits. This calculation here, however, is just saying based on the current sales mix, how many of each of those products do I have to sell just to break even, right? And this analysis is important because different products have different contribution margins. So if you sold 3 products and they all had the exact same contribution margin, the calculation would be really simple. The reality is when you take your sales minus your variable costs to get your contribution margin, that's likely going to be different for each one of those products. So how do we go about doing it? Well, it's a 3-step process, right? And I've listed them here on the slides for you. So you can go through them nice and slow. Step 1 is to calculate the weighted average contribution margin per unit of all the products combined, right? Now, the way you do that is you take the contribution margin, so you can see here the first calculation. We have product 1 unit contribution margin. You take that, the contribution margin for product 1, and you multiply it by the percentage of sales that product 1 makes up. So in that example that we did at the start of the video here, I said that product A was 50% of sales. So you would take product A's contribution margin and multiply it by 0.50. Then you would add that to product B's contribution margin times, I think we said 20% of sales. And then if in our example there was a third product, so you would actually have to add, so you would say at the end of this, you would say plus product 3's contribution margin times 0.30, the 30% of the sales that are made up. What you end up with, and what this is doing, is effectively taking the contribution margin for each one of the products and weighting it based on the percentage of sales. Right? So step 1 gives us the weighted average contribution margin of the entire company based on our current sales mix. Okay? Then we can take that weighted average contribution margin and dump that down into step 2. And step 2 is to calculate the break-even point in units for the company in total. Now that's just your standard calculation. Normally break-even is fixed costs divided by contribution margin per unit, right? Well, instead of using contribution margin per unit, in a multi-product company, you're going to use the weighted average contribution margin per unit instead. So step 2 is to take our fixed costs and divide it by weighted average contribution margin per unit. That gives us the break-even point in units. Now, here's the key. That break-even point in units is not the break-even point for each product. So if I come up with a break-even point of 15,000, that doesn't mean I have to sell 15,000 of product 1 and 15,000 units of product 2 and 15,000 units of product 3. What that 15,000 units represents is the total amount of all sales. So if you took all the units of product 1 we sold and added it to all the units of product 2 and added that to all the units of product 3, if you added all of them up, it would equal 15K. All right? So this break-even point in step 2 is the total number of units that need to be sold by the company across all products. So we're still not done though, right? So we've calculated the weighted average contribution margin and we've come up with the break-even point in total. We still haven't been able to say, well, how many units of product 1 do I have to sell? How many units of product 2 do I have to sell in product 3? So the way you finish this off, step 3, is to take that break-even point in total units and simply multiply it by the sales mix for each one of the products. So if our multi-product break-even point was 15,000 units and product 1 was 50% of sales, I would take 15,000 units and multiply it by 50% to get my break-even point of product 1. And then you would just repeat that step for every product in your sales mix. So if product 2 was 20% of sales, you would take the multi-product break-even point of 15,000 units and multiply it by 0.2. And that's the number of product 2 units you need to sell. And so on and so forth. Right? So again, it's a 3-step process. Step 1 is to calculate the weighted average contribution margin of all products combined. And the number of calculations you see here will be directly determined by the number of products. In this example, there's only 2 products. If you had 5 products, you would do this calculation 5 times and add them all up. Okay? Step 2 is to calculate the break-even point in units based on that weighted average contribution margin. And then the last step is to allocate that break-even point out to each of the individual products. So that's how it works in a nutshell. But let's go to Excel and let's take a look at how it actually looks when we work through a question. Now I've got them on this CVP formula sheet and I've got them listed in order. So step 1 is the weighted average contribution margin, step 2 is the break-even point, and then step 3 is to allocate them out to an individual product. Okay? So let's go to Excel and I've got a practice question here. So multi-product break-even point. So Carter Corp sells 3 different hockey sticks. We've got the curve, the composite, and the carbon. Information for each of the sticks has been presented below. We've got the curve, composition, and carbon. So the selling price of the curve stick is $50. It has variable costs of $40 and a sales mix of 60%. Okay, the composite has a selling price of $100, variable costs of $70, and a sales mix allocation of 25%. And finally, you have the carbon. It's the most expensive stick. It costs $400, has variable costs of $300, and a sales mix of 15%. In total, the company has fixed costs of $199,500. And the question is asking us, it says the required is how many of each model must the company sell in order to break even? Okay, so here's the trick, right? We know based on what we just talked about that calculating the multi-product break-even point is a 3-step process. This question has simply asked us for the last step. What's the break-even point in each individual unit? We can't answer that without doing the first 2 steps. So in most cases, regardless of what's asked of you in the question, you're likely going to have to do all 3 steps. Unless it's just asking you for the first part and saying what's the weighted average contribution margin per unit. But if the question is asking for how many of each unit or each model must the company sell to break even, we're going to need to go through each of our 3 steps. Okay? So step 1 was calculate the weighted average contribution margin per unit. Here's our formula. Since I have 3 products, I've got the carbon, the curve, and the composite, I'm going to need to do 3 calculations and add them all together. Okay? So to start, what I'm going to do is I need the contribution margin for the curve stick, and I'm going to multiply that by the sales mix, right? And then I'm going to add that to the composite and add that to the carbon calculation. The issue is that currently I don't have the contribution margin for any of these sticks. Now, you've done this a number of times probably already, right? You should have done this a number of times already. In calculating contribution margin per unit. So I'm not going to belabor the point. I'm just going to dump that in right here. So contribution margin per unit. I'll just do contribution margin. So contribution margin per unit. We know by now that contribution margin is selling price minus variable costs. So for the curve, the selling price is $50 and the variable costs are $40. So the contribution margin is $10 per unit. The composite costs $100 and has a variable cost of $70. So that makes the contribution margin $30. And the carbon has a selling price of $400 and variable costs of $300, making the contribution margin for that unit $100. So for every curve stick we sell, we end up with $10 that we can put towards variable cost, or sorry, fixed costs and profits. The composite sticks make us $30 that we can contribute towards those two items, and then carbon we make $100, right? So obviously, since the carbon is our most expensive product, it kind of logically has the lowest sales mix volume. Probably not a lot of people that are out there looking for $400 hockey sticks, and probably more that are looking for the $50 hockey stick. So this is our information that we're going to use to come up with the weighted average contribution margin per unit. So for the curve, I have a contribution margin of $10 per unit, and that represents 60% of my sales. So if I take $10 and multiply it by 0.6, I get a weighted average for that model of $6 per unit. Now I need to add that to the weighted average contribution margin for the composite stick. And the composite stick has a cost of $30 per unit and a sales mix of 25%. So if I take $30 and multiply it by 25%, I get a weighted average of $7.50. Okay? We're also going to have to add in the weighted average contribution margin for the carbon stick. Now the carbon stick has a weighted average or a contribution margin of $100, and it represents 15% of our sales. So if you take 100 and multiply it by 15% or 0.15, you end up with a $15 amount. Now to get the weighted average contribution margin per unit, you simply add up all three of those together. So 6 plus 7.5 plus 15 is $28.50. That's the weighted average contribution margin. We now have step one done. What we can do now is use this weighted average contribution margin per unit and use it in the break-even calculation. So step two is to calculate the break-even point in units. And the key here is that this is the break-even point in total units. It means that if we added up all the curve sticks, the composite sticks, and the carbon sticks together that we needed to sell to break even, this is the number that would be represented here. This isn't the number for each individual stick, it's the total. So what we need to do is take our fixed cost. We're going to do the standard calculation. We're going to take our fixed cost, but instead of just dividing it by contribution margin per unit, we're going to divide it by the weighted average contribution margin per unit. Okay? So in this case, the question said that our total fixed costs for the company were $199,500. Okay? So I take $199,500 and I divide it. Sorry about that. I take the $199,500 and I divide it by this weighted average contribution margin that we just calculated, which was $28.50 per unit, right? So if I take $199,500 and I divide it by $28.50 per unit, that means that to break even, I need to sell 7,000 total units. That is the total number of all the curve, carbon, and composite sticks added together. Okay? Now, and this is good practice for whenever you're answering a question on a test or anything like that, you gotta cycle back to the question and ask yourself, did I actually answer what the question was asking? So I've come up with a break-even point, but if I go back up, the required says how many of each model must the company sell in order to break even? We haven't answered that yet. We've said how many units in total need to be sold, but we haven't broken that out between the curve, the composite, and the carbon sticks. So the way that we break out this $7,000 is simply based on the sales mix that was given. So we have to assume that that sales mix will continue on into the future. So if I'm going to sell 7,000 units and 60% of all sales are the curve stick, I can use that information to figure out what the break-even point is in terms of curve sticks that need to be sold. Okay? So we basically, what we need to do is we need to take this $7,000 right here. Right? We need to take this, or 7,000 units, and we need to allocate it to the curve, the composite, and the carbon. So what I do is I just list the models down here that I need to allocate it to, and I'm going to take 7,000 units, because that's the total that we need to manufacture, and I'm going to allocate them to each of these based on the relative sales mixes. So the curve sticks represent 60% of our sales, the composites represent 25%, and the carbon represent 15% of all sales. So to allocate out the break-even units to each of these products, I just take 7,000 times 0.6, and that means that 4,200 of the sticks that are going to be sold will be curve sticks. 7,000 times 25% is 1,750 composite sticks that'll be sold. And if 15% of all the sales are carbon sticks, that means that 1,050 of those break-even sales will be the carbon sticks. Now, because I'm an anal retentive accountant, I always want to make sure that the numbers I'm calculating are done right. And I know that since I'm only allocating out 7,000 units, the sum of the three models, the curve, the composite, and the carbon, should equal 7,000. So I just do a quick subtotal to make sure. And if you add up all three of these, there's those 7,000 total units that you're expecting to sell. But the break-even point, when we do it this way, we can now express it in terms of each one of these models. So the answer to the question is, to break even, this company must sell 4,200 curve sticks, 1,750 composite sticks, and 1,050 carbon sticks. Now, if the sales mix changed for any reason, you would have to redo all this work. The main assumption that we have to make here is that this sales mix is going to stay constant so that we can do this allocation at the very end. But that, in a nutshell, are the three steps for allocating or calculating the break-even point for a multi-product company. Right? So step one was to calculate the weighted average contribution margin per unit. Step two was to calculate the break-even point in units, and that's in total for the company. And then step three is to allocate out that total break-even point into the individual models. And again, the number of allocations in this last step is going to be directly related to the number of models of product that are being sold. So if you only have 2 products, you're only going to have to do 2 allocations here. If you have 5, you'll have to do 5. Okay? But that's it in a nutshell. I think that's it for our CVP, our cost volume profit discussions. The next playlist is probably going to be on incremental analysis, which is basically it's the best chapter in the whole book. You basically get to use numbers to help make business decisions, like should we outsource a product or should we make it ourselves? Which one of these products in a multi-product company should we sell to maximize profits? So how do we use limited resources to maximize profits? There's a lot of really good stuff in the next chapters, and I'm going to be putting out some videos very shortly on those as well. So that's it for this one though. Hope you enjoyed it. Cheers, and I'll see you next time.